And the fake news is saying, oh, if you fired him, it would be so bad. It would be so bad. I don't know why it would be so bad. So we have a stupid person, frankly, at the Fed. I call him Too Late Pal, because he's always too late. I know within 3 or 4 people who are going to pick. I mean, he goes out pretty soon, fortunately, because I think he's terrible. I'd love him to resign if he wanted to. He's done a lousy job. Jerome Powell's been very bad for our country. We should have the lowest interest rate on earth, and we don't. He just refuses to do it, and yet he's spending $2.5 billion rebuilding the Fed. He's a terrible Fed chair. I was surprised he was appointed. We're not planning on doing anything. We're very concerned.
President Trump denying that he's trying to remove Fed Chair Jay Powell, even after raising the idea in a closed-door meeting with congressional Republicans that leaked to the media. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. The speculation about Powell's future stirring up fresh turmoil for traders. We'll get more on what to watch with Pimco MD and portfolio manager Erin Browne. Also ahead, Trump says more than 150 countries will soon get letters on tariff rates of 10 to 15% a day after sealing a deal with Indonesia. We'll dig into what that means with one of Southeast Asia's most respected voices on trade, the Indonesian president's special advisor, Mari Pangestu. And the marriage of convenience is officially off. Circle K operator Couche-Tard abandoning its $46 billion bid for Seven & I, accusing the Japanese firm of a campaign of deliberate delay. We'll get insight on what it means for the takeover target as shares slide in Tokyo with Monarch's Group Expert Director Jesper Koll. Well, markets are wavering as the long-running saga between Trump and Powell comes back in focus, though the president's denial of a plan to oust the Fed chair helped soothe some concerns. Erin Huang is here to break it down for us. And Erin, it does seem like the dollar is the clearest loser in this.
Yeah, I think that is the narrative, the takeaway we've been seeing, not just in the reaction overnight, but it's interesting how we're seeing a bit of a reversal higher in spite of that idea. But certainly it's against this backdrop of analysts warning that there could be financial market turmoil if Trump indeed moves to oust Powell. So overnight we saw a bit of a sneak peek of what might come amid speculation of a potential move. Stocks, the dollar, short end yields, they all decline. Now, in terms of the dollar, aside from what we're seeing on the narrative that potentially is the biggest loser, it's also worth noting that there wasn't a sort of major repricing in markets across assets overall. And in terms of the stock market reaction, there are some that have pointed out that this is a market that still wants to move higher. So unless we see the start of, disappointments on forward guidance, that equities could remain bid. Now flip the board and take a look at the Treasuries curve reaction as well. Certainly we saw that curve steepening on the short end. Investors are pulling forward their bets of earlier Fed rate cuts. On the long end, investors are, betting or wanting greater risk premium. It's not just about how there could be this potential undermining of Fed credibility. It's also about the legal ambiguity. Does this set things up for longer running legal spat between Powell and Trump? Now, I would also just note, if you just flip the board, some of the bosses on Wall Street, what they've been saying about the importance of Fed independence. You take a look at the comments from Jane Fraser about how this is absolutely critical for the effectiveness of capital markets. We also had the likes of David Solomon saying that, this is something that they should fight to preserve. Also, hearing from the JP Morgan CEO about how this is something that's important not just under Powell, but also under his successors. In the meantime, we heard from the likes of Brian Moynihan as well. Take a listen.
In May of next year, the term of the current Fed chair ends after being reappointed, and it's the right of the elected president to appoint the next successor and go through Congress. And I think in that dialogue around that, there'll be a lot of dialogue about, okay, how do you set interest rates? What do you think about interest rates? Because the Fed is an independent agency. I think no matter who gets in, they're going to look at it and have to look at the facts and make a decision, because if you drop rates too far, inflation may kick up, and then you're going to have to raise them back quickly.
Wall Street's bosses there underscoring the importance of Fed independence, Haas.
Errol, thank you so much for that. Let's get perspective from Erin Browne, Managing Director and Portfolio Manager at Pimco. She manages multi-asset strategies at the firm. Erin, good to have you with us. It's not just about tariffs now. It's also about Fed independence. What are you making of this drama happening as we speak?
Well, I think the market is right to really downplay the reality that that President Trump may try to fire Jerome Powell. Not only is this because we don't think it has legal merit, but also because it's just not helpful for the Fed to be undermined in terms of its independence. And so ultimately what we're thinking is that what President Trump is really trying to do is trying to put pressure on Jerome Powell to leave the Fed once his term is up in 2026. Now, remember that he can still stay on until 2028 as a Fed governor. And so there's some concern about him being still on the the Fed board, but not as the head of the Fed. And so what we think is he's already indicated that he's not likely to stay on at the Fed. And we think Trump's trying to really turn up the pressure, dial up the pressure, so that when his Fed chair term is up in 2026, he steps down and leaves the Federal Reserve and doesn't stay on through the completion of his term.
Erin, might the markets be underpricing the risk that perhaps Powell might leave sooner than expected? This is a president who's used to getting what he wants, and the case in point would be the negotiations on tariffs and trade with trading partners.
Well, I think there's 2 points to this. First, I actually don't think it would be helpful for Jerome Powell to step down for President Trump. And the reason for that is I think that would really call into question whether or not Federal Reserve independence is being, under attack. And what I think is going to be most effective for him is to stay throughout his term. And Jerome Powell himself has indicated he has no intention of stepping down early. And I really believe that he's likely to stay in his seat until his term is up in 2026, which is not too far along from where we are today. So I think he's likely to stay in his seat. He's likely to continue to have rhetoric from President Trump putting pressure on him. But I think that pressure is really trying to engineer Jerome Powell out at the end of 2026, not out, at the end of 2028.
How might this play out in the markets? When you take a look at 30-year yields, they're back above 5%, and some say perhaps you can expect the term premium to continue to rise.
So I think that term premium is likely to rise, but I don't think it's entirely being driven just by this pressure that President Trump is placing on Jerome Powell. I think in part it's also driven by the fact that given the more solid growth picture that's emerged in the second quarter of 2025, we're unlikely to see rate cuts in the middle part of this year, and it's likely been delayed until the end of this year. And so there was a lot of fear coming out of Liberation Day in April that we would see a very sharp deterioration in macroeconomic data, and we just haven't seen it yet. In fact, U.S. data has continued to hold in, quite strong. The labor markets also have continued to be quite robust. And so the need for the immediacy of rate cuts, I think, has been delayed. And that, I think, is also leading to the short-term rise that we've seen in yields.
Have you been surprised by demand for treasuries? I mean, it wasn't too long ago that we expected international demand for U.S. treasuries to actually decline from here. But here we are, well supported, and that's reflected in the last two auctions.
Yeah, not only that, when you look at the TIC data or the Treasury flow data from abroad, it's actually continued to see purchases of U.S. Treasuries. So we're seeing from all the official sector data that Treasury purchases have remained quite strong. What's interesting is when you look under the surface, there have been real shifts in terms of who the buyer base is. So we've seen a continued deterioration of buying out of China for U.S. Treasuries, but Japan has actually increased and held in quite, strong. In Europe, purchases of U.S. Treasuries have held in as well. So while optically you continue to see real demand, you are seeing nuances in terms of who that buyer base is. And when you look across the globe, U.S. yields are quite attractive relative to other developed market economies. And so that, higher yield advantage continues to benefit the U.S., which is why I think you've continued to see strong buying for and strong demand for U.S. assets.
Erin, what's the best way to play the bond market, given that we've yet to see the impact from Trump's tariffs?
Right. So, I think that the biggest for the U.S., for investing in the U.S., I think yield curve steepeners is going to continue to be the right play, meaning you want to be long the 5-year part of the curve, but short the 30-year part of the curve, which is going to continue, I think, to be hampered by the one big beautiful bill and the tremendous amount of fiscal stimulus that's likely to hit in the U.S., which is likely to continue to lead to term premium being priced back into the back end part of the curve and for the yield curve to continue to steepen. I also think that owning Treasury inflation-protected securities, or TIPS, also makes a lot of sense right now. They're quite attractively valued. They offer, I think, a good yield. But I think that you'll continue to see concerns about inflation weigh on nominals, and owning inflation protection, I think, is really reasonable, and you can get it at a really cheap price right now. So for investors that are looking to own Treasuries, I think owning Treasury inflation protected securities makes a lot of sense. The other thing is, we think that the U.S., because of the strength of the data, because inflation is likely to persist a little bit stickier because of the one big beautiful bill, we think that it makes sense to look outward in terms of positioning with respect to duration. So we like EM duration here. We like UK duration as well. We also like Australian duration. But I think taking a more diversified approach in terms of how you are owning duration makes a lot of sense, because there's going to be, because of the macro environment, a real diversion, I think, in terms of how central banks are approaching policy.
Erin, great insights. Erin Browne, Managing Director and Portfolio Manager at Pimco. Thank you. Now, still ahead this hour, insights on Indonesia's tariff deal with the U.S. and the implications across Southeast Asia with former Trade Minister and current Special Presidential Advisor Mari Pangestu. Keep it here with us. This is Bloomberg.
We're very close to India.
Wow.
And we're very close to, we could possibly make a deal with the EU.
President Trump giving an update on U.S. trade negotiations on the Real America's Voice network. Trump also says he'll be sending out letters with a tariff rate of between 10 and 15% for more than 150 smaller nations. This may benefit some countries in Asia, as the blanket rate would be lower than the levies Trump has been applying to individual nations. Meanwhile, Indonesian President Prabowo Subianto has confirmed he's agreed to a 19% tariff rate in a deal with Trump after months of talks. Even so, Prabowo says he may visit the U.S. in the coming months to continue pursuing better trade terms. And Indonesia's central bank quickly cutting rates 25 basis points on Wednesday, catching analysts by surprise. Bloomberg Intelligence says the move was likely triggered by the trade deal. Well, our next guest is one of Southeast Asia's most respected voices on global commerce. A seasoned policymaker and economist, she has navigated multiple international trade negotiations. Mari Pangestu is also a former Indonesian trade minister and is now special advisor for international trade and multilateral cooperation to President Prabowo Subianto. Ibu Mari, good to have you with us. First off, what do you make of that 19% level? We know that it is down from 32, but it's still almost double what it was before.
Yeah, I think you're going to have to look at it in relative terms. Okay, 19 is still better than 32, and 19 relative to other countries at the moment anyway, is still lower than our other competitors, providing the goods that are going to be most impacted for us, like garments, footwear, seafood products, furniture, even our usual products like palm oil. We are at a lower relative rate compared to others, so it helps our competitiveness in terms of access to the U.S. markets. But of course, we will continue to be talking to the U.S. There are other components to a trade deal that we would, of course, like to have more benefit coming to us.
The thing is, some people say it was a one-sided deal. Perhaps, it was just Indonesia giving up concessions, but the U.S. getting away with almost nothing, including the fact that Indonesia will allow U.S. corn, U.S. chicken to come in without any tariffs, and that might be detrimental to local businesses.
I think we have done the analysis, and if you look at the situation before the reciprocal tariffs, in fact, 38% of U.S. goods were already coming in at 0%. And then if you go 0 to 5%, it's almost 68% of U.S. goods. So U.S. goods were already coming in at a low tariff. And what we have provided increased access are goods that are not competing with Indonesia, or goods where we don't produce enough. Yeah, so we don't produce wheat, we don't produce cotton. So those are two products that we will be increasing the purchases of. And then there's soybean meal and beef. We will be providing access to the beef quota and so on, and some products like rice and milk. But the thing is, it's really not increasing our imports per se. It's sort of shifting some imports from some other countries, as well as the fact that these are all commercial deals that will be, of course, have to be done on a competitive and business-to-business term. So we don't foresee that there will be a big impact on the import side going into Indonesia, whereas on the export side, we expect that this will have a real positive impact for our labor-intensive industries and will prevent the potential for retrenchments that we had been predicting if we were facing the 32% tariff, as well as growth and investment. We've done in our National Economic Council some analysis which actually shows that if the tariff was the full 32%, we would have a negative 0.5% impact on our growth, as well as impacting our exports and investment and having unemployment. But if with a 19% tariff, given the relative differences with other countries, being lower than other countries, our competitors, plus the fact that we provide market access to the U.S., we would actually end up growing at 0.5% higher. We would have increased investments, consumption, as well as, most importantly, we would actually increase in employment, right? So I think at least that's the one aspect of the analysis that we're showing. Of course, there are other components of the economy that we need to take into account.
Ibu Mari, some are suggesting that in the end, it is the American consumer who will bear the cost of these tariffs. What do you say to that?
I believe so, because we've been doing, obviously, talking to private sector, including our own private sector, the buyers and the retailers. And what the main takeaway is that I think most production and exports are likely to continue. In fact, we saw some recent investment numbers which show that investments continue to increase into ASEAN, including from the US. So they're not about to dismantle their supply chains. They're just going to continue. Maybe they will diversify, but what they will do is input the higher cost from the tariff into the price, and that will be divided, the increased costs will be divided between the producer, exporter, the buyer, and the retailer at the end, right? So there will be a price increase. The end result will be a price increase. We don't know how much. It will depend on the product. And let's not forget there are still sectoral tariffs to deal with in semiconductors, in aluminium, in steel, and there's more coming, right? That's the other area where we as Indonesia, we also want to continue to negotiate with the US. So I think these are some of the issues that we need to manage. And most importantly for us, looking at it from a domestic and regional perspective, is that actually this is an opportunity also. It looks like supply chains are still going to continue. They're going to be more diversified.
Right.
This is going to be an opportunity for us, and we need to get our own house in order, as well as strengthen regional integration.
As part of the trade deal, Indonesia has agreed to buy about 50 Boeing jets. I'm just wondering, how confirmed, how solid is this agreement? Because it does seem like Garuda doesn't yet have the ability to make those purchases.
Well, as you know, Garuda, there's been an investment injection from Danantara into Garuda. So Garuda is in the process of being, if you like, revitalized. And so purchases of the Boeing jet is part of the process of revitalizing Garuda. So I believe that you need to see the processes in parallel to see that there are things being done, being undertaken to improve Garuda's performance and ability, obviously, to purchase these Boeing jets. So I believe these are, if you like, commitments, right? These are commitments to purchase. And as I said earlier, these are commercial deals that will have to be done business to business at the end of the day.
We know that talks will continue, at least according to the president. Prabowo has talked about how talks are fluid. He will meet with President Trump later. I'm just wondering, how realistic is it that the tariff rate can still go lower from here, or is it just hypothetical? Well,
as we all know, trying to predict these things is no longer easy to do. But I think what we are going to be doing is continue to negotiate with good intention, find further areas for partnerships, for increasing business interactions between the U.S. and Indonesia, and developing areas of interest to the U.S., such as they want to diversify critical minerals supply chain. They want to they want to develop resilient supply chains. These are actually potential areas where we can have so beyond tariffs, where we can have potential partnership and investment as well as trade flows. So we will continue in a constructive and positive manner to negotiate, to discuss, to have dialogue with the U.S. But of course, as all countries, we will make sure that our domestic interests are well guarded. So it is not about opening up totally and giving in everything to the U.S. It is more nuanced and balanced as what maybe appears to the outsider who's not involved day to day in the negotiations.
Right. Ibu, any indication when that meeting between Prabowo and Trump might happen and where that might happen? And how crucial is it that it happens soon?
No indication, but of course, sooner is better than later. But what is more important is to lay the ground, right? So laying the ground means our negotiating team is still in the U.S. right now, and we're also continuing to prepare the ground in Indonesia, and we already have the connections with the counterparts in the U.S. So this will be important to lay the ground, to continue the dialogue, to find the opportunities where we can really see a win-win outcome.
Thank you for your time today. Mari Pangestu, Indonesian President's Special Advisor for International Trade and Multilateral Cooperation. Still to come, the Manex Group joins us to discuss the outlook for Seven & I after Couche-Tard announced it's abandoning its $46 billion takeover bid. This is Bloomberg. Welcome back. You're watching Insight. Japanese markets just coming back online again after the lunch break ahead of the upper house election set for July 20th. Of course, the yen front and center. The market's preparing for more yen weakness if Prime Minister Ishiba's ruling bloc loses its majority in the upcoming upper house. I'm suggesting perhaps a slide past 150 may be possible. The Nikkei 225 currently negative territory, down about 0.1%, but the topics is higher. We're taking a look at the yen right now, currently at 148.56 is the level we're looking at versus the USD, down about 0.5% right now. Election risk and Japan's mounting debt burden fueling debate on whether its sovereign rating may be cut sooner rather than expected. And we're also tracking moves in 7&I today. That stock currently down by more than 7%. Couche-Tard withdrawing its $46 billion buyout bid for 7&I. 7&I says it regrets that decision. Now, for more on what's next for the Japanese retailer, let's get to Bloomberg senior editor Reed Stevenson in Tokyo, who's been covering this story for us. Reed, first off, what happened? What went wrong?
Indeed. I mean, it's been a saga lasting for about a year now after it became public that Couche-Tard, the Canadian operator of Circle K stores, was interested in 7&I, the global operator of 7-Eleven convenience stores. And really, we've seen a lot of twists and turns here, but essentially, 7&I, in response to this unsolicited friendly offer, sought to find many ways to really rebuff Couche-Tard, and a lot of that had to do with arguing about the difficulty of gaining regulatory approval, but at the same time trying to prove that it can go it alone. And essentially to do that, 7&I embarked upon a pretty radical restructuring of the company, including selling off less profitable retail operations, buying back shares, a planned IPO of the U.S. convenience store business, and even appointing a new CEO. And despite all of that, despite signing an NDA agreement and really trying to work through some of these issues, Couche-Tard felt that there's really no meaningful engagement with the company. They had sort of ruled out a hostile takeover bid. So for now, they're really, hitting the pause button, if not permanently, and just leaving 7&I to itself. And so in response, as you just noted, the shares fell almost 10%, losing a significant amount of their value. So there's definitely skepticism out there about what the future holds.
The thing is, 7&I has rejected the claims made by Couche-Tard. Does it have any basis for that?
Yes and no. I mean, it really kind of depends on which side you look at. Couche-Tard actually sent out a fairly detailed letter to 7&I's board, citing very specific incidents where the engagement didn't seem to be as full and meaningful as it had hoped. 7&I's statement was much terser and shorter, suggesting that maybe that Couche-Tard had a point after all, and so really it's sort of which side you choose. But I think the investors have pretty much come to their own conclusion when you look at the share reaction here.
Reed, thank you so much for that. Bloomberg senior editor Reed Stevenson in Tokyo for us. Let's get more insights now with Monex Group Expert Director Jesper Koll. Bloomberg Intelligence Asia Consumer Analyst Leah El-Hage is also with us. Jesper, let's start with you. This was always going to be challenging. This was always going to be difficult. You're talking about one of the most successful and, high-profile companies in Japan.
No, exactly. It's one of the greatest consumer experiences here in Japan. It's the pride and joy. And yes, there is work to be done. And there is no question that, already Couche-Tard's negotiations until now, as well as some of the activists coming through, have actually woken up the board, woken up the executives. And I think from now on, it's very clear it's Japan for the Japanese, and rolling up your sleeves to actually improve profitability and performance of the global franchise. That's the key issue. And the Japanese executives of 7&I do have their work cut out for them.
Well, Leah, Couche-Tard expressed great frustration. Just to paraphrase what they said, it sent a letter saying that Seven & I engaged in a calculated campaign of obfuscation and delay. Those are really strong words.
Yes, I agree. There has been resistance for that takeover, and there's been strong resistance. But then if we look at it from a broader perspective, Couche-Tard is a retailer from the West. So should have the takeover taken place, they would have brought in some more standardized retail approaches to the company versus Seven & I's really customized, tailored approach that they have. So that would have probably caused a clash as well. And as rightfully pointed, so that has woken up management, and now they are actually aware that they've been slow to respond to change, whether it's consumer preferences, whether it's the broader environment. So they are aware of that. They've been under a strategic overhaul, and if that works, that we could see upside and more like growth coming from the company. It could take time, but if that works, then that it could be a good thing for the company as well.
Jesper, you were nodding?
Yes, no, I'm nodding, but look, the whole thing is like, the issue is a made in Japan global franchise. Can they actually pull this off? I mean, they've got about 22,000, shops here in Japan. They've got, give or take, 15,000 in the US. And most importantly, they've got over 50,000 shops in Asia Pacific. And building that franchise, that's going to be the big challenge. In my personal opinion, operationally, Couche-Tard could have helped them in the overseas businesses, but they've obviously decided under the leadership of the new president, Stephen Dacus, Seven & I has decided to do it on themselves. And I think, look for comparison at Uniqlo, which also successfully built over the last 3 or 4 years a global franchise. So I think that Seven & I rolling up its sleeves, doing it by itself, watch for the August strategic report that the company is going to present. Watch for that vision to actually show how the global made in Japan franchise is going to be built.
We know, Leah, that Couche-Tard actually proposed a new structure. Is it a good structure?
In my personal opinion...
Well...
Go ahead. Go ahead.
No, go ahead, please.
No, you go ahead.
Leah?
Yes. So the structure that actually Seven & I are going to undergo, where basically they're planning to IPO their North American operations, that could be a good thing because they could extract value from the operations there, and they could repay their large buyback program, their 2 trillion yen buyback program they're undergoing, and they would need M&As as well in order to expand. So that structure could probably work for them.
Jesper, some say perhaps this is Japan's protectionism in great display. What's your response to that?
I don't think it has anything to do with Japan protectionism. I mean, the question is, what is best for the franchise, not just what is best for shareholder. And I think the key issue is that Seven & I was a very sleepy, dare I say, lazy company until 3 or 4 years ago, when the first activists started to come into play. It clearly is the jewel that should be punching much, much harder, not just here in Japan, but on the global scale. And so what has happened with this Couche-Tard bid is that, these competitive spirits in Japan have now increased. And I think that you will see, the Japanese headquarters here in Tokyo actually spearheading and leading, a very, very credible and good global franchise strategy.
What do you think, Leah?
I think it's totally right. It's about what's good for the franchise. As I've previously mentioned, probably bringing in another Western approach to a Japanese company probably would have caused a clash. There's a lot of value to be extracted. So it's all about bringing the Japanese know-how globally. So this is the success of 7-Eleven in Japan, how it's operated, the freshness, the speed, the products. So this is about bringing that globally and obviously slightly customizing it to customers' need in different regions. So there is definitely a lot of potential to be unlocked. And if execution is done properly, they could probably get there as well. Like we've mentioned the Uniqlo example previously.
Leah, are there still options? Are there still options open for Couche-Tard right now? Could it buy perhaps the international business of the company? What might still be open?
Well, they're planning to IPO their U.S. business in 2026. They could buy a stake into that. That could be an option. Or they could get into a smaller stake rather than just taking over. That could happen. But yeah, I think that could be some of the options.
Jesper, a minority stake in the company perhaps?
Look, I mean, we'll see. What they want to do in North America is North America. But for me, the North American business has always been a little bit of a sideshow in the sense of that the real franchise value boost way above the premium that Couche-Tard was prepared to offer actually lies in the Asian franchise. Because the Asian franchise is the one that is punching below its weight. You've got, high growth nations like Vietnam, like Indonesia, where the franchise model that 7&I operates currently can actually be revamped, can be brought in-house under greater control. And that's where I think the real growth potential is. North America, what you do with that, fine, there's the potential for the monopoly law to sort of become an obstacle there. But the real point is, and what you really want to watch out for in August, when the 7&I management team delivers its new strategic plan, watch for the Asia franchise growth strategy.
And how might that look like? What are you anticipating, Jesper?
I wish I knew. I wish I would be that operator there. But you've seen an example. They operate effectively on a franchise model that is built out, but that has been subcontracted, so to speak, to a couple of operators, and buying those operators in, taking control. They did that already with their Australia franchise earlier this year. Watch this space.
What's your own take, Leah? I mean, considering that this is a company that's seen its profitability fall for quite some time now.
Totally agree with the Asian franchise. So they're mainly operating on a master licensee model in Asia. So they've bought the Australian franchise, and now they're working on improving the business. So there's the Vietnam. They're also investing directly into Vietnam, although haven't bought the master franchise yet. But also this entails a big price tag to buy these franchises. So they could probably either increase their leverage. So with a 2 trillion yen share buyback program, probably a large scale M&A, their cash won't be enough for them to do that. So they will have to find more funding in order to buy the Asian franchises and to engage in large scale M&As as well.
Jesper, you're about to say something?
No, I was going to say, look, I mean, the key issue is not that this is old-style Japan protectionism. Quite the opposite. This is actually an injection of energy and competitive spirits into a Japan-led management team that is actually very international. I mean, Stephen Dacus, the new CEO, he knows Japan well, he speaks the language extremely well, but he certainly does bring global and international diversification and management sharpness to that. So I think that, this is not a sign of, oh my God, the Japanese are circling the wagon, they don't let foreigners in. Quite the opposite. This is a new Japanese global team of a super franchise actually rolling up its sleeves and saying, hey, watch us. We can do this.
Yes, but to your point, it is not about protectionism. It is about, we can do this. But are there some key takeaways from this drama, which has gone on for quite some time?
I think that the key takeaway is keep on trying. I think that that there is a mergers and acquisition boom in Japan. You've got some leading Japanese companies failing at acquiring other companies, like Nidec tried to acquire Makino Milling, and that didn't work out. They agreed to part. So it's this metabolism in the corporate world in Japan that's definitely open for global businesses to try and present their strategies. But it's also a new home team here in Japan that is actually very competitive and full of animal spirits. Bring it on.
Bring it on, Leah. Is that how it looks like?
I think the key takeaway as well is there's a lot of value to be extracted in these Japanese companies. And I think the key is in faster execution, faster adaptation to the environment, and to be more agile. And if they can do that, then I think they could actually build a global empire. And yeah.
Yep.
And yes, my final word, agility, actually, it's quite complicated for Japanese companies. They do things in a more deliberate and time-consuming way. Perhaps that's not the way how the, international companies look at it.
No, but look, and Leah made an important point because, global companies from a Japan perspective are always focused on extraction of value. The Japanese are not interested in extracting value. They're interested in creating value. And that's, I think, where it gets interesting. Just, reshuffling the balance sheet, all of these sort of Zytec, financial game playing is all very nice and well. But the real focus is what is in it for the franchise? How do I build a better franchise? How do I build, a better customer experience? That's where Japan comes in. It's about value creation, not value extraction. And I think the 7&i management team, in my personal opinion, is a very good bet that they will actually create value for both shareholders, the franchise, and for customers.
Jesper, Leah, great conversation. Monex Group Expert Director Jesper Koll and Bloomberg Intelligence Asia Consumer Analyst Leah El-Hage there. Thank you so much for that. Coming up, we look ahead to TSMC's second quarter earnings report, with analysts forecasting a fourth straight quarter of over 50% profit growth. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. NVIDIA chief Jensen Huang says he hopes to get the first batch of renewed U.S. licenses soon to export H20 AI chips to China. Speaking in Beijing, he told us his company, along with the supply chains, will adapt to any changes in the trading landscape.
The world is reconfiguring itself, and we are a company, and we just have to adapt to whatever the world's trade and tax and tariff conditions are. There were trade, taxes, and tariffs before I came into NVIDIA. There will be trade, tariffs, and taxes after I leave NVIDIA. And so this is something we all have to adapt to.
Let's get more on this now and bring in our tech correspondent, Annabelle Drewlers in Taipei, who's been on the Jensen Huang trail. Bell, it's a win for NVIDIA, but we don't know how long that will last.
Yeah, that's right. It's really a lot of unknowns still for us, even though, of course, the Jensen Huang and the market generally is interpreting this sort of about term from Washington as a positive. But yes, he spoke about this yesterday, just trying to understand, I guess, this expectation of how much customer demand there is in China, and also the inventory that they have stockpiled, of course, of the H20 chips that they couldn't sell since April. Where should that be placed? Because analysts have been thinking maybe they'd lose up to $15 billion billion in data center revenue this year. How much of that can now be clawed back? The other question, of course, is how much those customers in China may have already switched to other competitors in the market. So again, assessing that demand dynamic, but certainly for Jensen Huang, who has been very consistent in his messaging around this and that push toward Washington to ask them to repeal those harshest restrictions at the risk it of course built into the self-reliancy or self-sufficiency of China, it is of course a positive for NVIDIA.
And Belle, we know that Huang is on a tour in China, and he said that it's been a great trip so far. It's been quite a successful trip for him.
Yeah, that's right. We've definitely heard him talking about a number of possible customers in the market, but the likes of Alibaba, Xiaomi, for instance. So certainly he's likely meeting with a lot of different business people on the sidelines of this. But it's very interesting timing for the trip, which we've been saying. But just around that meeting with President Trump now in China, the announcement comes. It comes as well from NVIDIA, more led by the business side than the White House. That specter, though, that it is still a bargaining chip in the negotiations, of course, is an important one, because that's one of the key questions in this. And as you said, they don't know how long these licenses are going to be granted for. Could they be revoked? And how long as well until it takes to get that first approval for shipment once again.
And elsewhere in the chip space, Belle, trade tariff risks will be in focus when TSMC reports earnings later. In terms of the numbers, what exactly are we expecting?
Yeah, so in terms of the numbers, well, we're expecting them to be strong, so it could end up being a fourth quarter of growth, or profit growth above 50%, a fourth straight quarter, that is. But that's because as well we do get those monthly sales figures in Taiwan for the companies that are listed here. So we've already sort of had the guidance. We're likely to see still the more advanced semiconductors really leading revenue generation as well. But in terms of what we're watching out for, because there's a couple of key different areas, and the first one, of course, really relates to their business in the US. Particularly because we know that Taiwan and the US could be getting closer to a trade deal. We had reporting yesterday that Taiwan at least is thinking it could come before August 1. Would they be looking to speed up their capex there as well, because there are incentives in place for them to do just that?
It is about whether or not continued spending will be seen in the AI space as well, Belle.
Yeah, that's right. I mean, it's again, as I said, that big focus on capex. We've continued to see them ramping up there and really focusing on their operations in the American market at the expense of, say, Japan, where they've definitely delayed some of their investments into their Kumitomo plant. But what else is going to be really key to watch as well is just the FX implications, because we've seen a really rapid appreciation of the Taiwan dollar that has been playing into their sales figures. So what do we get in terms of how they're managing those FX risks, and as well any of the possible conversations they could be having with central bankers around that? I mean, it's unlikely maybe we'll get it in the earnings call, but still a very interesting point, and one that analysts are going to be watching out for very closely.
Annabelle Drulis in Taipei, thank you so much for that. Now, before we go, here's a look at our show tomorrow. We'll have an exclusive conversation with Indian Hotels Company CEO Puneet Chhatwal after their latest earnings results drop later today. That is it for Insight. Horizons Middle East and Africa is next. This is Bloomberg.